Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Alphabet, ticker symbol GOOG. This is obviously the parent company of Google. I think that this company could be a very high quality, good addition to your portfolio, especially with all of the recent antitrust lawsuits that they're going through, and just all of the unlucky things that's happened to Alphabet over the past year. Currently, the stock is up 27% in the past year with a market cap of $2.28 trillion, with a PE ratio of 24.2 and an annual dividend yield of 0.43%. I think that this company is going to benefit greatly from AI, specifically because they're going to be able to get better ads. And I think that this company is trading probably at a discount. I haven't done the DCF yet, but I think that this company probably has a lot more room to grow in the future. I think that they've just been, going through a period of growing pains. I think that this company understands AI better than most, and it might be a really good time to buy into it. Looking at the actual analyst opinions of the stock, the majority of them have either a buy or strong buy rating, with analyst price targets ranging between $200 to $235, with an average price target of $218.72. I think that analysts definitely see the same thing that I'm seeing. This is a very high quality stock that is dipped, where a lot of the other Mag 7 names that are high quality have not traded at this low of a market cap. I can give you examples of Nvidia, Apple, Amazon, Meta. Meta actually is probably at a lower market cap. Overall, Google is an extremely high quality company with a diverse set of products that they offer, and I think that this stock could definitely be worth a lot of money in the future, as they understand AI, and they're kind of better than Apple because they've really acted on this. They've acted on the cloud services that they have. They've also acted on just overall AI, and I think even if they don't develop the next big AI, they're going to benefit greatly from it, like I said before, because they're going to have more personalized ads. And when you have more personalized, better advertisements, you can make a lot more money. I also think that YouTube is really just one as the platform that's the most mainstream. It's bigger than TV, and I think that they're going to continue to grow that out and just continue to make it better for content creators. Taking a look at our weighted average cost of capital, we can see that they essentially have almost no debt. It's only 1.11% of the total value in the weighting compared to their enormous market cap, and this is kind of to be expected. So you can see that this weighted average cost of capital corresponds very closely with the cost of equity, and that totally makes sense just because, again, they don't have a lot of debt relative to their market cap, and I really wouldn't expect Alphabet to have a lot of debt just because they're such a high quality, long-standing company. They've been able to make just so much money that it wouldn't make sense for them to need any debt on the balance sheet in a significant way. And when we look at our DCF, we can see that with an 8% growth rate of the free cash flows on average over the next 9 years, Google would be valued at $189.36 per share, and this represents an upside of 1.33%. And I think that this is actually probably very conservative. I think that a closer free cash flow growth rate would be near that average revenue growth of 10.78%. I think that just right now they're spending a significant amount of capital on CapEx, but I would actually rather they do this than just return the money to me, because this is going to mean significant increases in revenue and free cash flow in the future. And one of the things that big companies like Alphabet struggles with is finding growth. You can see that in the most obvious example of Apple. Apple has made smartphones. It's worked great. They've grown it to an enormous size, but there really isn't a lot of areas for them to grow in other than foreign markets. And because of that, they're kind of behind on some of the higher margin things. Like Alphabet is competing with AWS and Microsoft's Azure in the Google Cloud. They're also competing in the AI race. They also have YouTube. They have a ton of different areas that could grow pretty significantly. And I think because of that, we can look at the average free cash flow growth rate, but I think that it's kind of misleading because we have such a drop from 2021 to 2022. And the trailing 12-month number is pretty much by far the best number. I don't know why this is showing up as a negative. I must have had a negative free cash flow there before. You could see that the average free cash flow growth rate is 3.35% after this revision. That's obviously not, again, it's misleading because Google is going to be able to, or Alphabet, excuse me, is going to be able to grow significantly into the future. And I think that this is actually probably a buy. And I look at tons of stocks all the time. I'm super critical about them. I'm very conservative. The last time I thought two stocks were a buy, it was Amazon and Meta, so take that for what it is. This isn't obviously financial advice, and I'm not a financial advisor. You can kind of see, I think that both of those plays are long-term plays, but I'm already up over 20% on my Meta holding from when I bought in January, and I think that Google could have the same trajectory, especially since you can see from the chart down here, it has dipped pretty significantly, and its 52-week high was $208. I think that Alphabet could be an amazing buy right here. I also think that it's going to take time, though, for the free cash flow to increase, and it's hard to say whether that's going to be in 1 year, 2 years, 3 years, but if you have a long-term horizon for investments, I think that Alphabet could be an excellent addition to your own portfolio. Now, I think you have to do your own research and break down some of the segments more because I've really just kind of broken down the financials in a very raw way. I think that if you dive deeper into it, you can find more things to be excited about with Alphabet, but there's also the consideration that they've been targeted a lot more than the other tech companies, and this could be a significant downside to the stock. So there are some potential dangers, but you also have to consider that a lot of these things have already happened. If management is smart, they will probably learn their lesson and not allow these things to happen again. These same types of lawsuits happened to Microsoft. Microsoft was completely fine. And if you look over the past year performance, a 27% increase is pretty good for investors. So I think that this could be actually a really good stock to add to your portfolio. I think that I might add some of this to my own portfolio, but I want to do an actual DCF on Microsoft first before I make any definitive decisions because I want to be very smart about where I put my money. And I think that those two stocks are extremely high quality. They make a ridiculous amount of money, and I think that Alphabet has finally come out of being a value trap and being a genuinely good stock to own for the long term. Let me know what you guys think down in the comments section down below. If you've made it this far, I would love it if you hit the subscribe button. Thank you so much for watching. Bye.